Joining us now is Michael Kantrowitz. He is Chief Investment Strategist at Piper Sandler. Thanks for being with us. And really the place I want to start right now is this just a garden variety correction that maybe perhaps is even overdue after such a strong first half of the year? Or is it the start of something steeper in terms of the selling?
We'll see. I would say, though, the catalyst has been weaker data and specifically worsening employment data. And when you look back through history, there's really two catalysts that create corrections in bear markets. It's when interest rates spike, like we saw in 2022, or when the unemployment rate starts to accelerate, which potentially we're beginning to see now. So if that continues, yeah, I think the markets are going to remain under a lot of pressure.
You talk about in your notes the fact that you expect we're now going to see a positive correlation between interest rates and stocks going forward. Why, and what does that mean for the types of sectors that are going to benefit?
Yeah, we had been bullish this entire year on this theme of what I called softy locks, which is moderating growth and moderating inflation, bringing interest rates down, which we viewed investors seeing that as being a bullish catalyst for equities because beginning of the year, investors were still worried about the potential for a Fed rate hike, for higher rates and higher inflation. Now that has been pretty much exhausted. People are not really worried about inflation. The Fed's very likely to be cutting the next meeting. And so when we get bad data, there's no more inflation relief. There's no more the Fed's not going to tighten relief. It's now in rising recession fears. So I think that's why we're seeing that flip. So I don't think lower rates are good for equities anymore. For the sectors, it's utilities has been one of my favorite sectors for several months now. I've kind of labeled it the Iron Man sector because it has so many traits and potential catalysts to outperform, whether it's AI exposure, which led to a pretty big rally in the month of May, or today and the last several weeks, it's got a lot of bond exposure and it's very counter-cyclical. So it played offense in May and it's playing defense now.
Michael, you also say the rotation into small caps is over. Why?
Yeah, I think it is. Well, I think, if you look at small caps, that trade was 4 days. It was July 11th through July 16th. That was the peak in the Russell 2000. And it was entirely multiple expansion. It was entirely built on the idea that rates are going to come down and they're going to continue to come down. And that's going to be good for equities. And the catalyst, of course, was the good inflation report. Now we've seen rates continue to come down on, as you guys were talking about earlier, a bad ISM report, a bad employment report. We've seen weaker housing data. So I think it's over because the fundamental backdrop for small caps continues to deteriorate. They're the most economically sensitive. And if the unemployment rate's going up and credit spreads are starting to widen, I think small caps are the last place you want to be.
Well, given what Amazon did today, what Microsoft has been doing lately, I wonder, what are the chances you think that everything goes down?
Well, that's where we're beginning to see this systemic broadening. And I think, again, part of that goes to that we've seen credit spreads start to pick up despite interest rates coming down. And again, that's been on employment rising and other macro data being pretty soft on a broad basis. So from a stock picking perspective, what we've been recommending is looking for stocks that have above average stability in their earnings, visibility in their outlook, and strength in their fundamental statements.